driving the prices and the market trend of gold. Before we begin, I'd like to do a sound check. If you can hear me, just type yes in the question box. Also, during the webinar, if you have any questions, you can also type them in the question box, and I'll address the questions at the end of the session. Okay, it looks like everything can hear me. We'll begin tonight's webinar. My name is Phil Gunn, the speaker for the webinar. I've been with Phillip Nova for 17 years since 2008, holding a dual license in futures and stocks. And I'm an account manager to help clients trade in futures, forex, as well as shares, with understanding the product and market by providing coaching and economic information to make proper trading decisions. Gold has been experiencing a bullish trend this couple of years and has reached new highs. As the market dynamic in this new era of tariffs, let us re-evaluate the main factors that will affect gold prices in 2025. Throughout the webinar, you may have questions. Feel free to post them in the question box. My facilitator will arrange them, and I'll answer them at the end of the webinar. The webinar itself will also be put up after today, on the YouTube, so you can revisit the webinar again if you wish to do so. Let's get started. Before we start, just a disclaimer on the webinar today. Materials provided here is for general information and does not constitute a recommendation or solicitation to trade. So this is the agenda for today. We'll start off with the analysis of the key fundamental factors in 2025. What are the key price drivers for gold? Then we'll follow up with a technical analysis using charts and the potential gold trajectory in the near future. After that, we'll understand Comex gold futures, the specifications of the contracts, and so on. Lastly, if we have time, we'll go on to the trading platform, the quick demonstration of the Nova 2.0 platform. Okay, the gold has been a valuable asset throughout history, serving as a store of value, a medium of exchange, and an investment instrument. Its importance in the global economy has remained consistent despite fluctuations in the financial markets. This presentation explores the key factors driving gold prices in 2025 and how various economic and geopolitical elements shape the gold market. Gold has historically been considered a store of wealth. Its price trends have reflected broader economic conditions, investor sentiments, and central bank policies. In the early 2000s, gold was traded at relatively low prices, hovering around $250 to $300 per ounce. However, it has since moved from the 2008 financial crisis, and investors sought refuge in gold, causing the prices to surge very quickly to $1,800 per ounce by 2011, almost a $1,000 movement. More recently, amid heightened inflation concerns and economic uncertainty, gold prices continue to surge and have surpassed $2,000 per ounce, now closing into $3,000. The significance of gold in financial markets is undeniable. It acts as a hedge against inflation and currency devaluation, making it the preferred investment during periods of economic instability. Many investors view gold as a safe haven asset also, meaning it tends to perform well during financial crises. Furthermore, gold-backed financial instruments such as ETFs and futures contracts has now allowed even more investors to gain exposure to gold prices without holding the physical metal. Central banks, most of all, plays a crucial role in the gold market, maintaining gold reserves to stabilize national economies and thus supporting the price of gold as well. Let's look at the key players in the gold industry. The gold industry consists of several key players which influence the supply and demand. First, the mining companies, such as Barrick Gold and Newmont Corporation, are responsible for extracting the gold itself from the earth. They influence the overall supply of gold, which can impact prices depending on production levels, mining costs, and geopolitical factors. The major players in the mining industry are the Barrick Gold Corporation based in Canada, one of the largest gold producers in North America. Africa, and Latin America. Next, the Newmont Corporation, a major global player with mines in the US, Australia, Ghana, and Peru. And AngloGold Ashanti, the South African. Significant mining operations exist in Africa and South America. So, for example, during the COVID-19 pandemic crisis, it disrupted mining operations globally, reducing supply and contributing to gold price surge above $2,000 per ounce. Let's look at the investor and market participants. So investors play a very critical role in determining gold prices, buying and selling the gold in different forms based on market conditions, economic trends, risk sentiments, etc. So the first investor type, the hedge funds and institutional investors. These are large funds which use gold as a hedge against inflation, market volatility, and currency fluctuations. The second group of investors are the retail investors. These are individual investors like yourself who buy physical gold via coins or bars or trade gold-backed ETFs and even speculate through futures and spot gold contracts. Next, we have the sovereign wealth funds. These are usually at the national level, where some government investment funds hold gold as part of the national wealth preservation strategy. So the investment methods are as follows. First, we have the physical gold, where you can actually just buy the gold itself using coins, bars, or jewelry. This is very popular in India and in China. This forms the basic but a small part of the physical demand. Next, we have gold ETFs, the exchange traded funds traded on the exchanges. The funds like the SPDR Gold shares allow investors to trade gold without physically holding it. This is like buying shares on gold executed through the exchange. Next, we have the gold futures and options. These contracts are more suitable for speculation and hedging and very volatile. They are traded on markets like the Comex exchange. And of course, you can also indirectly invest in gold through gold mining stocks by investing in these companies. How investors influence gold prices. When there's a high demand for gold in ETFs, it often correlates with rising gold prices. Economic uncertainty, example like recessions, will drive safe haven buying, pushing prices up. Next, a strong US dollar of rising interest rates, can make gold less attractive, causing prices to decline. We'll go in detail later on. For example, during the 2008 financial crisis, gold prices surged as investors sought safe haven assets amid stock market turmoil. Similarly, in 2022, gold saw increased demand due to geopolitical risks like the Russian-Ukraine war. Next, the central banks and government reserves. Central banks play a crucial role in the gold market by holding reserves and influencing currency values. They buy or sell gold based on economic conditions and monetary policy. Central banks, including the US Federal Reserve, the European Central Bank, People's Bank of China, they hold significant gold reserves and influence global market trends through their policies. For example, the major central bank players like the US Fed holds over 8,000 metric tons of gold. ECB also use gold and form part of their foreign exchange reserves. For China, the People's Bank of China has been also steadily increasing their gold reserves to reduce dependence on the US dollar. The Reserve Bank of India also frequently adds to its gold reserves to support its currency and stabilize its economy. So why do the central banks hold so much gold? Because of currency stability. Gold acts as a hedge against fluctuation in their fiat currencies. And also for economic security, countries with a high gold reserve like the US and Germany use it as a safeguard against financial crisis. Most often and not, also in monetary policies like reducing dollar dependence. Countries like China and Russia have increased their gold purchases to diversify away from the reliance on US dollar reserves. So these are the figures for the central bank gold reserves. The figures highlight the significant role that gold reserves play in the national financial strategies, with countries like United States and Germany maintaining substantial high holdings. Emerging economies like China and India has also been increasing their gold reserves, reflecting a global trend towards diversifying assets and strengthening economic security. As of February of 2025, the World Gold Council reported the following gold reserves for the central banks worldwide, shown here. Additionally, consumer demand, particularly in India, China, and Middle East, also drives the market for gold jewelry and industrial applications. Next, let's look at the macroeconomic factors, one of the factors that drive gold prices in 2025. Firstly, inflation. Gold is historically seen as a hedge against inflation. When inflation rises, the purchasing power of fiat currency declines, making gold more attractive as a store of value. In 2025, if global inflation remains elevated due to factors like expensive fiscal policies, supply chain bottlenecks, or energy price shocks, gold prices are likely to rise as investors seek protection. For example, if central banks struggle to control inflation despite the rate hikes, gold could also see a sustained demand. Next, interest rates. Gold is a non-yielding asset, meaning it doesn't pay interest or dividends. When interest rates rise, the opportunity cost of holding gold reserves make it less attractive compared to yield-bearing assets like bonds. In 2025, the trajectory of interest rates will depend on central bank policies. If major central banks like the Fed Reserve or the European Central Bank maintain high rates to combat inflation, gold prices may face downward pressure. However, if rates are cut, which is what it's currently doing now, due to economic slowdowns or recessions, gold could rally further and as investors shift to safer assets. Global growth. Economic growth trends influence gold prices in two ways. First, strong growth. During periods of robust global growth, riskier assets like stocks, equities tend to outperform, reducing demand for gold. However, if there's a weak growth or recession in times of economic uncertainty, gold is usually the preferred safe haven asset. In 2025, if global growth slows down due to factors like high debt levels or structural economic challenges, gold prices could rise as investors seek stability. Next, let's look at the geopolitical risks. For war and conflict, ongoing escalations or escalations of conflicts, such as the tensions in the Middle East we see right now, could drive gold prices higher. Or for example, like geopolitical hotspots like Ukraine or Taiwan see increased military activity, investors may flock to gold as a hedge against uncertainty. For trade tensions, trade disputes between major economies such as the US and China can disrupt global markets and increase demand for gold. If the trade tensions resurface or escalate into a trade war, gold prices could benefit from the resulting economic uncertainty. Supply chain disruptions. If there are disruptions to the supply chain for gold mining and refining, this will also boost prices in gold. Next, looking at market demand. Gold demand comes primarily from three sources: investment, jewelry, and industrial use. Mainly the investment demand, I would say. Investment demand includes purchases by individuals, institutional investors, and ETFs, which is fund managed by managers. It is highly sensitive to economic and geopolitical conditions. In 2025, if financial markets face volatility due to recession, stock market correction, or currency devaluations, investment demand for gold can surge. ETFs like SBDR Gold Trust and iShare Gold Trust will be key indicators of investor sentiment. Next, we also have jewelry demand, which also makes a significant portion of gold demand, particularly in emerging markets like India and China. Also for industrial use, such as electronics, healthcare, and renewable energy, is a critical component in some semiconductors and medical devices. However, this industrial demand is a relatively small part compared to the investment demand. A quick scenario for 2025 here. In a bullish scenario, if inflation remains high, interest rates are cut, and geopolitical tensions escalate, which is the current situations for these three factors now, gold prices can surge as investors seek safety. For example, gold can break above $3,000 per ounce. Right now, it's actually testing this level, and this is a perfect storm with a combination of these factors. In a bearish scenario, if inflation is controlled, interest rates is maintained or remain high, and global growth accelerates, gold prices could face downward pressure. So for this downward scenario, it could go for a correction towards a $2,200 level. Let's look at the various investment options in gold. So there are four options here. First, gold has been a cornerstone. So using these four ways, the first one, physical gold. Let's talk about gold bars, coins, and jewelry. The biggest advantage of physical gold is this is a tangible asset, which is a physical one with intrinsic value. You can own it directly. There's no counterparty risk. It's a proven hedge against inflation and currency devaluation. So second, we have the gold ETFs. These are funds that track the price of gold and trade on stock exchanges. The biggest advantage of gold ETFs is the convenience of trading in it. They're easy to buy and sell. You don't need to worry about storage or insurance. They also track the price of gold pretty closely. However, they come with management fees and counterparty risk, so you're relying on the fund issuer. The third one, gold mining stocks. Another way is to invest gold indirectly through gold mining stocks. These are shares of companies involved in gold mining. The advantage here is potential for higher returns compared to actually just buying the physical gold, slightly better returns, but mining stocks are leveraged to gold prices, so there's additional risk. And although some mining companies also pay dividends, they are subject also to stock market volatility, so that's something to note as well. Finally, we have the gold futures. These contracts to buy or sell gold in a bi-directional market, so even you can take advantage on the downside of the market if gold is coming down. The biggest advantage is also the leverage that they offer, allowing for significant gains with a very small capital. This is a double-edged sword. Of course, if the direction goes against you, your losses are also increased. However, with the implementation of very small contracts like the micro Comex contracts, retail investors are able to dabble into gold futures more easily with better risk management. In conclusion, gold offers multiple investment options. Each has its own advantages and risks. Physical gold is great for stability, ETFs for convenience, mining stocks for leverage exposure, and futures for bidirection leverage positions. As we move into 2025, gold's role as a safe haven asset and inflation hedge will remain critical. All right, let's just do a quick comparison of gold with other assets, namely gold versus stocks. First, comparing to stocks, stocks offer high potential returns over the long term and provide ownership in growing companies. They pay dividends, which can be a steady source of income. However, stocks are highly volatile and sensitive to economic cycles. In contrast, gold tends to perform well during stock market downturns, making it a valuable diversification tool. While stocks offer growth, gold provides stability and acts as a hedge against market volatility. The second, we compare it versus bonds. Of course, bonds provide stable income through interest payments and are considered lower risk compared to stocks. Government bonds in particular are seen as safe haven assets, similar to gold. However, bonds are vulnerable to inflation and rising interest rates, which erode their real value. Gold, on the other hand, can also act as a hedge against inflation and offers capital appreciation during times of economic uncertainty. When bond provides steady income, gold offers protection against inflation pressures. Well, nowadays there's a lot of cryptocurrencies, so let's compare gold to cryptocurrencies. Cryptocurrencies like Bitcoin offer high potential growth, but they are extremely volatile and face regulatory risks. Unlike gold, cryptocurrencies lack intrinsic value and rely heavily on market sentiment. Gold, with a long history and a store of value, is more stable and reliable during economic crises. Cryptocurrencies offer high returns, but gold remains a safer and more dependable asset. So, in summary, gold still stands out as a unique investment in 2025. It offers stability, acts as a hedge against inflation and economic uncertainty, and provides diversification to your portfolio. While stocks, bonds, and cryptocurrency each have their own advantages, gold's reliability and proven track record makes it an essential part of your investment portfolio. Next, let's look at the key risk factors and portfolio diversification. Well, we know that gold is often seen as a safe haven, but it's not without its risk. Let's look at what are the risks involved when trading in gold. First, price volatility. Gold prices can also fluctuate due to economic conditions, central bank policies, and global events like geopolitical tensions or pandemics. For example, during the COVID-19 pandemic, gold prices surged but later corrected itself as markets stabilized. So, short-term price fluctuations can lead to losses if gold is bought at high price and sold during corrections. So, entering with a correct size position with not overexposure to the risk of volatility. The next is the impact of interest rates. Rising interest rates will make gold less attractive compared to income-generating assets like bonds. This is because gold does not generate income, so its appeal diminishes when interest rates rise. Why? Because higher rates make yield-bearing assets like bonds more attractive. But currently, we are not really in a interest rate rising scenario. So in 2023, for example, central banks raised their interest rates to combat inflation. Gold prices at the time faced downward pressure. So rising rates can cause some reduce in demand for gold, leading to price declines. Finally, market manipulation and speculation can influence gold prices, making it difficult to predict short-term movements. Gold prices can be influenced by large institutional traders, central bank buying, and speculative activity in the futures market. For example, central bank gold purchases recently impact the gold prices as well, as we see countries like China stocking on a stockpile of gold. So let's see how you can use gold in a diversified portfolio. Financial advisors usually recommend allocating about 5 to 15% of your portfolio to gold. This range provides sufficient exposure to gold without overexposing your portfolio to the risk in gold. Gold is particularly valuable because it counterbalances the equities market during the market downturn. For example, during the 2008 financial crisis, gold prices rose while stock markets plummeted. So the gold provides stability during the economic uncertainty. By adding gold to your portfolio, you can reduce the overall risk and protect your wealth during turbulent times. Alright, now let's look at the projection in the bullish scenario. The bullish case for 2025, where prices can rise above $3,000 per ounce due to persistent inflation and increasing demand from investors and central banks. First and foremost, inflation is one of the biggest drivers of gold prices. When inflation is expected to be high, say above 3 to 4%, the purchasing power of money declines, making investors looking for assets that hold the value over time, such as gold. Tariffs can lead to higher inflation by increasing the cost of imported goods. When companies face higher costs due to tariffs, they pass this cost to consumers, leading to rising prices for goods and services. Gold is widely considered as a hedge against inflation, meaning that when inflation rises, gold demand increases. We have seen this in the past. During the 1970s, there was an inflation crisis. Gold prices surged from $35 an ounce to $800 in just a decade. More recently, after the 2008 financial crisis, inflation fears lead to a bull run in gold, pushing prices to nearly $1,900 per ounce in 2011. Once again, by inflation. If inflation remains high in 2025, history suggests that gold can once again see a major price surge, potentially exceeding $3,000 per ounce, which is what it is currently testing right now. Economic slowdowns and central bank rate cuts. The second factor that could drive gold higher is a slowdown in global economic growth. If we enter a period of stagnation or recession, which stands for high inflation and low economic activity, the central bank is likely to cut interest rate to stimulate growth. But what does it mean for gold? Lower interest rates reduce the opportunity cost of holding gold. Unlike stocks or bonds, gold doesn't pay interest or dividends. But when interest rates are low, investors don't mind holding non-yielding assets like gold. So once again, example of COVID-19 pandemic, interest rate was slashed to near zero, and gold prices surged to an all-time high of $2,075 per ounce in 2020. If we see another period of rate cuts in 2025, demand of gold could once again skyrocket. Next, increased demand from central banks. Let's talk about central banks and their growing role in the gold market. Recently, countries like China, India, Russia has been aggressively accumulating their gold reserves. Why? Because they want to diversify away from the US dollar and reduce their reliance on foreign currency reserves. Over the past decade, these nations have been buying hundreds of tons of gold each year. For example, in 2022, central banks globally added nearly 1,100 tons of gold, the highest annual purchase on record. This trend is expected to continue into 2025. If major economies increase their gold holdings, it creates a supply crunch in the market, further driving prices higher. If China, India, and Russia accelerate their gold purchases, prices can easily break above $3,000. Lastly, geopolitical instability, boosting safe haven demand. One of the most unpredictable but powerful factors driving gold prices is geopolitical uncertainty. When there's global turmoil, be it wars, trade disputes, trade wars, economic sanctions, or supply chain disruptions, investors always flock to gold as a safe haven asset. History has shown this pattern time and time again. For example, in 2008 financial crisis, gold surged by nearly 3% as investors sought safety. After Russia's invasion of Ukraine, gold prices also briefly topped $2,000 per ounce, making markets very volatile. So if global tensions such as trade wars, Middle East conflicts continue, investors will likely see increase their gold holdings, pushing prices higher. So these are all the factors giving the basis for projections on the bullish market. Let's explore the bearish case scenario. In the bearish case scenario, is the possibility of the money tightening by the central banks, particularly the US Fed. When inflation is under control, it's no longer high, central banks tend to keep interest rates high to stabilize the economy. But how does this impact gold? Higher interest rates increase the appeal of interest-bearing assets, such as bonds and saving accounts, making gold less attractive in comparison. Unlike bond or cash deposit, gold does not generate interest or dividends. So when the rates are high, investors move their money into assets that offer better returns. For example, in the 1980s, under the Fed chief then raised interest rates to combat inflation. The result, the gold prices plummeted from $850 per ounce to nearly $300 per ounce by 1985. If central banks in 2025 follow a similar path and keep interest rate high, gold could experience a downward trend. So declining inflation also reduces the need for gold. Gold only thrives when inflation is high because investors see it as a store of value. However, if they can keep inflation down, people are less likely to buy gold for protection. Instead, they may invest in other assets that give better potential. We saw this happen in the 1990s when inflation remained low and gold prices hovered around $250 to $400 per ounce for nearly a decade. If inflation remains stable in 2025, gold prices can see a similar long-term stagnation or decline. So a strong stocks market also attracts investors away from gold because they give better returns and people like to put their money in high growth stocks. For instance, in 2013 to 2019, during the stock market bull run, we can see gold prices remain relatively flat. There was not much movement in gold. After this strong, if we see a strong economic growth, investor confidence in stocks will drive gold prices downward. So the dollar also makes gold expensive for international buyers. For example, the US dollar strengthened between 2014 and 2015. Gold prices dropped $1,300 per ounce to $1,050. So if dollar remains strong, this could be impetus for gold demand from international buyers could also decline, further weighing on the prices of gold. Lastly, the industrial demand of gold can also affect. Next, let's look at the technical gold outlook. So, a brief history of gold. Since 2008, gold has been a very long-term uptrend. After the subprime mortgage crisis, gold rose swiftly from $800 an ounce to $2,000 an ounce, after which it took a correction down to $1,060 per ounce, almost a 50% correction. But the rebound was quick and once again tested $2,000 an ounce. Then it started to consolidate in the range of 1,650 to 2,000. After multiple attempts of breaking 2,000, it finally broke it, and a breakout occurs, what we are seeing right now. Continued to test $2,800 recently, after which a quick retest of $2,600 support, and is now testing 3,000. As from the historical movement, one big step in gold is about $800 movement, as seen from the movement of 1,200 to 2,000, and later on from 2,000 to 2,800. So if you look at where it comes from now, from 2,600, the $800 mark movement could be the $3,400 mark. This is something to observe if the market does indeed take us to that level. So some indicators you can use for tracking the technical side of a trending market is the EMA, exponential moving average. Although a lagging indicator, it can give you the first hints when prices cross over from above in an uptrend. For example, if prices cross the 40 EMA from above, it might be the first signal that the undergoing consolidation or even a deeper correction could be coming. Next, you can use Fibonacci extensions or retracements in the trending market to determine levels that are good support or targets for uncharted territory. I will show you how it's done later on the next slide. So looking at this slide over here, this is the daily chart for the Comex gold contract, which is the futures contract. As you can see, this is an uptrend since from the June, July of last year till now. Over here, I also drawn the trend line. Sorry, as seen over here. So this actually acts as a dynamic trend lines resistance for the upside. So whenever the prices reach that trend line, you can see it tends to hesitate and do a retracement downwards. So this could be the first target level that this movement be going towards to. So first indicator you can use is by drawing a trend line, diagonal trend line. So we can see that it has since broken off this resistance over here at the price of around 3,000, and has not even come back to test the support and is now moving towards the next level. So how do we project the next level in the uncharted territory? Besides the trend line resistance, we can also use Fibonacci extensions. This is drawn by using the lowest point we started off and doing a 3-point extension on this wave up. As you can see, the first level has already been crossed, 2982, and now it's heading towards the 50% extension at 3026. Coincidentally, this intersects with the trend line that is drawn, so this is a likelihood that there will be some resistance for retracement downwards if this price is reached. Of course, the next projection, 618, is a better one, and for 3069 resistance level. So using this Fibonacci extension, the new momentum of buying we see now is extremely strong. And of course, although we tend not to encourage buying, but looking at the buying momentum and the breakout, the resistance level 3026 and even 3069 could be possible targets. And there's a bias that we see that this testing is likely to occur. After which, I will be cautious and there will be a retracement pullback to consolidation above the psychological level of 2982. So this scenario could also be a false breakout, but looking at the movement today, it's likely that this is not a false breakout. As we approach the resistance level, do take note that the gold price can be very volatile and the downside selling can be huge as well, possibly at $80 to $100 movement per day if it does decide to correct. So do be careful when target levels are reached and make an appropriate adjustment to your risk exposures. So that's the technical outlook for myself for this gold for the coming up gold market in the near short term. We're now going to how you can make use of the trading online to invest in gold or speculate on gold prices. Well, we have the 1 ounce Comex gold, which is the smallest contract possible. This gold contract is so small that it's very suitable for newcomers who wants to trade in gold prices, both in the upside market and also you can sell first for the downside market to take opportunity if the gold prices retrace down. So for the 1 ounce contract, it's that's the contract size of it. The minimum tick movement is 0.25 in the price of gold is equals to 25 cents exactly. So it's easy to remember. $1 in the price movement is $1 gain or loss. And the trading of gold futures is almost 24 hours from Monday's morning 5 a.m. Singapore time down to Saturday morning 5 a.m. Singapore time. So it's almost 24 hours. The weekends is closed. So uh, trading resumes on Monday morning. And to take note that this contract is financially settled, so there's no delivery of physical gold. So if you approach expiry, you will need to liquidate the contract. Next, let's take a quick look at the calculation on the trades. So looking at Comex Gold, how much is required to start trading in this gold contract? Just a small value of 138 US dollars, which you can come in Sing dollars as well. But you'll be paying interest on the borrowed US dollar. So alternatively, you can deposit into the Nova platform, which is a multi-currency account, and convert to US dollars. But with as little as 138 USD or equivalent of Sing, you can start one contract. What you're looking now is the price codes for the Comex Gold. So assuming that we are looking to buy the Comex Gold and we have exactly 138 US dollars. Buying one lot of the micro gold contract size at 2920.1 and then the prices went up and we sold it at 2930.1. Since a dollar movement equals to $1 gain, you can see this is a 10-point movement. So 10 points equals to 10 US dollars. So it's very easy to track. 138 plus 10 equals to 148 US dollars, which is your final account equity. But you have also to take out the charges, transactional costs, commission charges, and exchange costs, which is a total of $1.90 USD for a round trip, meaning for the two trades of buy and sell. So this is an example of a positive profitable trade. Let's look at the loss scenario. So using also the 1 ounce micro Comex gold contract, this time instead of just $138, we have more than enough funds, which is 200 US dollars with excess funds of 62 USD, since we only require $138. So we bought the gold at the same price, one contract of one micro 1 ounce gold contract at 2920.1. Then we did not close the contract, but there's always a mark to settlement every day conducted at 5 a.m. Singapore time at the exchange and is released by the exchange. So the settlement price, assuming instead of going up, it drops down to 2860.1. So this is a 60 points drop from your entry price, and that will equate to an unrealized loss of $60. But how much is left in the account? Because you started off with $200, the account is now left with, after deduction of 60 unrealized loss, 140 USD. This is still higher than the margin required to maintain the position of using 138 US dollars. So there's no margin call and you can still keep your position. Of course, the next scenario, look at the margin call scenario. In this scenario, we have also $200 in the funds as excess funds of 62 US dollars. But instead of dropping only 60 points, this time the price drops to 2810.1, which is a drop of 100 points. This will give you a loss of 100, unrealized loss of $100. And you can see that this time the account is only left with $100, which is lower than the margin required level of 138. This is when a margin call is triggered, and you will need to top up additional 38 US dollars to maintain the position. So you have up to 2 days to do the top up, or if the market don't depreciate you further and erodes all the account balance in the account. So if you do not top up by the end of closing of the second day, the positions will be liquidated. So this is a scenario for margin call. You can always come back to this slide again to understand better on the calculation of trades. As you can see here, the exposure is much more controlled, although futures is a leverage product, but the contract sizes have been reduced so much that even for a volatile movement of $100 to $200, the movement is also $100 movement or $200 movement, which is, I would say, quite okay if you are a new investor. You can do as many lots as you want if you think this movement is too small for you. Next, we'll look at the demonstration of the Nova platform. Excuse me. This is the Nova 2.0 platform. This is an installed program on your desktop or laptop. We also have a mobile app for this. Um, the open account is absolutely free, and but I'll just show you how it works from the PC. There's also a web version of it, but this is better because you have the trading view charts as well. So just a quick show of what are the functions available. From the menu over here, this is a trade menu where you can see the prices as well as the trade menu. For news, it's all under Explore, so you can always, if you want to see it as news or suggestion for trades, you can always take a look, and sometimes they post it here. Next, you can also, this is a multi-currency account, you can also do currency conversion over here. If you have funds in the account, you can convert the Sing to US dollars. As Comex Go require US dollars, you can always do the conversion online as well. And our rates are much better than the banks, as one money changer with a very tight spread, which you will see when you do the conversion. For withdrawals can be done online from this trading platform also, and the statements can be downloaded once you've done any trades. Also, fund deposit can be done by generating QR code over here. You can just enter the amount you want, and it will generate for you to do the pay now transfer. Alright, that's for the functions of those tabs over there. Next, we'll look at how you add contracts to the watch list. So this is where you monitor the prices, and as this is a multi-asset class platform, you can see that there are various different asset classes available, from futures to equity, stock market, to FX. They are denoted color coded and also by the tickers, the symbols shown here. So from here, start you can just click on add symbols. Due to the various classes, you can click the asset class that you want. For example, if you would like to go to Comex Go, you can go futures. If you want certain categories, for example, the gold class assets, they will also suggest you what are the gold class assets that you have. For example, the ETFs for gold, the futures, the spot gold market can also be added. So let's go into the futures market here, and this is further separated, categorized by the exchanges. So Comex Go is traded on the Comex exchange, and you can see the 1 ounce contract is here, and also you have the regular contract sizes, which is a GD. So simply click on this, and there's an expiry for gold contracts. So typically we just select the active moment contract so that it will update the prices accordingly, and you don't have to change the watch days every time a contract expires. And once you selected it, you can see that the heart shape will be colored and it will be added to your watch list. So that's how you add any contracts you want. You can add stocks accounts just like here shown here DBS, or you can add futures Comex gold contracts like over here. So this is the regular size contract just for demonstration purpose. If you want to place a trade, there's a place order menu. Alright, so basically you can right click on it. But just a quick one before we go on placing our trades. You can look at the contract specs for each of the contract over here to understand how much margin is required and so forth, right? And the trading times and first notice loss trading date all available. So to place a trade, simply just right click and click place order. This will populate this trade order menu over here. You can see that the order type you can select as limit or stop limit orders. So viewing orders, we usually select limit orders. I will not go into details of this, and if you need any assistance on this, we can always arrange for a coaching session on this, right? And then input the order that you want by clicking on submit. Of course, you have to select the direction of the market clearly, as this bi-directional. It's possible to sell the contract even if you don't own it, and if the prices go down, you will gain from it. All right. So once the order is submitted, it will appear over here under working orders, and once the order is done, it will be completed orders. And the open position will show, and at the bottom is where your account balance is. They will show you the margin that required and how much funds is left, and the unrealized profit and loss all live and can be monitored from here. All right. Next, we'll look at the chart over here. So if it's too small for you, you can actually make it bigger. Right. So this is adopted with the trading view incorporated inside this Nova platform. So you have free access to the trading view by signing up for the Nova platform as well. Indicators you can just search as per trading view over here. Just give, and you can draw any Fibonacci's or this trend lines over here. For example, if you want to do a retracement, if it reaches the top already, you can click on Fibonacci retracement and draw accordingly. Let's say for here, you can draw on the chart itself as well. Okay, so that's for the charts. If you're interested for a demo account, the live account does not have the install version, but we have the URL version. You can also sign up for demo account. But opening of the account is actually free, so I'll go into details on how you can sign up if you want to try out the platform with access to the live price as well as the charts. Okay, so that's for the demonstration. Now let's go talk about the promotion that we have for the gold trading right now. So we are giving a pair of gold class movie tickets by just trading on if you place 2 trades in gold. So how does it work? The promotional period is from from 3rd of March to 30th of June. Um, so anytime when you place 2 different gold asset classes, so there are a couple of asset classes available. First, gold futures, which is the Comex gold futures contracts that we were talking about. Next, the spot gold, which is also available on the Nova platform, or MT5. Yeah, but you can trade that as well. And the gold ETFs, which also you can see on the Nova platform. Any pair of this, let's say for any combination of a gold futures with a spot gold, or gold futures paired with a gold ETF, or gold ETFs paired with spot gold, as long as you trade one lot in the respective class each, you'll be eligible for a pair of Golden Village gold class movie tickets. Very simple, right? So this this movie tickets will be given to you the following month, the 14th business day of the next month, following month. So for eligible clients that residing overseas and you cannot use the movie tickets, will be depositing a $80 credit into your account. So this is a very good opportunity for you to just start very small in the gold class, just place trade with in two of the asset classes, and stand to win a chance to not win a chance. You will get a pair of Gold class movie tickets right away once you place the trades. There's no lucky draw or whatever. It's straight up an opportunity to get the gold class movie tickets. So you can take opportunity of this chance to start gold, since gold also on a bullish market right now. In conjunction with this gold promotion, there's also another promotion for gold, which is the small 1 ounce Comex gold future contracts. So for this one, you can start as small as with $138 to buy one contract, and the promotion is that the commission is actually only 68 cents plus the exchange fees. As mentioned just now, the round trip it would be about 95 cents per trade, so a round trip will be 195. So this promotion goes on until the end of year end, which is likely to continue after that. So it's a good chance for you to start with a very small contract size and take opportunity of the promotions, of the two promotions that's ongoing. So Phillip Nova offers this Nova 2.0 platform as a one-stop platform to trade multiple asset classes, including stocks, futures, and forex. You can trade on the go with Nova trading app on your mobile smartphone as well, or on your PC desktop devices. For those devices on the PC desktop, you get a chart powered by the trading view, and you can gain access to over 100 technical indicators. Assess the market depth and view liquidity and trades for the particular price in the market easily. There is no maintenance fee, and you can monitor your trades wherever you want, whenever you want. So on top of that, if you sign up a free live trading account now, it takes only a few minutes using your SingPass account. There is no minimum deposit required. If you sign up using this QR code shown here, you can also sign up for a free one-to-one coaching session. The course will be on technical analysis demonstrated with our Phillip Nova platform. I'm a dual license holder specializing in futures, forex, and stocks. You will also receive daily updates on the economic data releases and technical advice via WhatsApp. Besides that, we have the in-house Trading Central research portal. Our in-house analysts will email technical reports on suggested levels for your reference. The suggested entry-exit levels for your consideration will be sent as daily trading highlights, showing directional views from the global research desk of Trading Central. These are starting points for your own research to identify opportunities that make sense for you. Markets include Dow Jones, Nasdaq, S&P, Nikkei, FTSE China, MSCI Singapore Index, crude oil, Hang Seng Index, gold, silver, etc. Next, for the fundamentals, we also have you covered. These are sent using commentary reports given to give you updates on the economic news happening around the world. This will keep you updated on the latest news that have a potential impact on the markets. You can also access this via the Nova platform through the Explore tab. This saves you the work of searching for all the information on the internet. Hence, we provide both the fundamental and technical aspects of trading information to you, and you can have a platform ready to enter the market whenever you're ready to start trading. Besides the analyst report, you can also reach out to me with technical views on your trades as well. So simply sign up for the free account now by scanning the QR code shown here. Take the opportunity of the two gold promotions and sign up now. If you have been thinking about trading in gold for some time, this is a perfect time with the low commission and the promotion of the free gold movie tickets. You can start off with the micro contract size of 1 ounce contract, where a small amount to start off will be $138 to try out the Comex Gold futures market. There are absolutely no platform fees or maintenance fees even if you do not trade. If you use this QR code, I'll be assisting you on your account matters, and you have a dedicated servicing account executive on your trading account. I look forward to onboarding you on this trading journey. So we have now come to the Q&A session. Let's try to answer some questions. Someone asked if the recording it will be shared. Yes, the recording will be shared after this tomorrow, or give it a couple of days. This will be emailed to you. For the coaching session is also free. It can be conducted online via Zoom, or if you prefer to come down to the office at Raffles City Tower, we can arrange an appointment. You can reach out to me via my contact details, which I'll share, and we'll go through basically the platform and explanation of any questions you may have, and also perhaps some technical um, indicators on the charts as well. So for the coaching, you can actually use this to sign up for the coaching session over here. If you wish to go for the one-to-one coaching session. So for questions on any demo account to try, yes, I will show you the demo account on the last slide later on for you to sign up to try. So if you want to sign up for the Nova platform demo account, feel free to scan this QR code over here for the Nova demo account. So I'll give you a minute if there are any other questions. So if there's any platform or maintenance fee, no, for the live account, there's no platform fee and there's no maintenance fee. So you can start off the free account opening and get access to the free live price access for certain exchange, which is covered on the Comex Go as well. And you also have access to the trading view charts. And whenever you are ready to trade, it's a simpler transfer of funds via PayNow, which can be received within 15 minutes or even 5 minutes if you indicate your trading account number. So it's very quick once you have it set up for the Nova 2.0 platform. You can always fund it whenever you are ready to start trading. So if you're interested to take advantage of the promotion, you can use my account opening link over here by using your SingPass. You can log on to open account. Account opening takes about 5 minutes of your time, and you can have the trading account ready for you to try out whenever you want. Okay, so I think that's all for today. I don't see any more questions. That's all the time we have for today. Feel free to drop me a message or email me if you want, shown here, if you have any other queries. Well, thank you so much for being a wonderful audience for tonight's webinar. A link to this recording will be made available in our follow-up email tomorrow. If you have any query on the webinar or would like to get started, just reply to our email and we'll get in touch with you. So this is Phil Gunn signing off, and have a good evening ahead.